Welcome to video 9D. So briefly, in chapter 5, we covered the timing of income for a cash basis taxpayer. We're basically going to finish out that conceptual area, so when to recognize income or deductions in this video, when we talk about the timing of deductions, and we talk about accrual income. Okay, this has the potential to be a long one, so let's get going. Section 448 puts the limitations on the cash method, right? So we recall from previous videos this magical now $26 million figure. In the old world, it was much lower. Neither here nor there. Any business, kind of irrespective of what you're mixed up in, what your activities are, what type of business you are. If your gross receipts are less than $26 million, you can continue to use the cash method. However, most large corporations use the accrual method. And they certainly do it for inventory because you also have to track whatever treatment you use for tax. If you use the cash method, you also have to use it for your books. And so that becomes a little less relevant because the reason that accountants invest so much in understanding GAAP accounting is because in theory it is superior to cash accounting. So larger companies really may abandon the cash method for the accrual method, but in any event, $26 million test. All right, let's talk about costing inventory here for a second. And the way we're going to do that is flashback to our old course where we should recall that direct materials plus direct labor plus overhead is your cost of inventory. And that overhead is where all the allocations occur, right? So we take all these expenses that aren't directly associated with inventory, but a piece of them become associated with inventory. Well, the tax rules are very specific on overhead allocation methods. And in almost all instances, they're going to result in a larger amount of overhead being capitalized in the inventory than booked. So think of it as the expense is rent. And this is a hypothetical example, but it's rent. And under typical accounting, we would allocate a certain amount of factory rent over to inventory, and it becomes capitalized as part of the inventory through the overhead allocation process. Well, the tax rule would simply say take more of that overhead and allocate it. So that's often called, you hear it described as UNICAP or 263 Cap A, because 263 Cap A is the code section that describes the process by which taxpayers have to go through to capitalize the cost of inventory. Okay, so let's look at a quick example of this. So this is the first year, and there's no sale of inventory, right? So this is our simplifying assumptions to help us better understand what's going on. So let's take our 4 overhead categories: factory salaries, admin salaries, raw materials, factory overhead, and accumulate those. Those are not all overhead, by the way. And let's accumulate those into the totals and then determine how much would get allocated. Okay, so factory salaries, that's your direct labor. So all of that goes to inventory. But salaries admin, you can see that is an overhead item. The administrative salaries, and under UNICAP, in this fake version, there's going to be a lot of yawning today, you guys. I'm sorry, I'm tired. More of it is allocated to inventory than under the book method. Raw materials are just your direct materials, so that's the same. And then factory overhead, you can see, has a much greater overhead allocation in inventory for tax purposes than it does for books. So what you end up with is a larger amount of cost tied up in inventory, right? So the total amount under book is $18,000. The total amount under tax is $24,000. The offset is the period costs, right? So period costs are costs you write off irrespective of the amount of inventory you create. Again, this is all flashback to cost accounting. The period costs, of course, have to be higher under book than they are under tax. So when you think about this, book has a much greater deduction amount, right? $8,000 is deducted, only $2,000 for tax, and the difference in that cost is just hung up on the balance sheet, right? In inventory. So in year 2, let's assume all of the inventory is sold. So again, simplifying assumption. What that would mean is cost of goods sold would reflect the entire amount of inventory we had booked at the end of year 1. But the total costs over both years, you could see, would be equal, right? Because the book would be the 18 plus 8, and the tax would be the 24 plus the 2. So the total cost is the same under both systems. It's just a matter of timing as to having to hang more of those costs up in inventory. Okay. So the reason I described that is Unicap and Cap 263A are big deals in some of the tax cost accounting world. We're actually not going to spend a lot of time on that here. All right, Regs 162-3, non-incidental materials and supplies are deducted in the year you pay for them or in the year they're consumed, whichever is later. And under the safe harbor, when you don't use the accrual method for inventory, this is the method you use. That's why I bring it up. All right, gross income under the accrual method. Now, we know that gross income is income from whatever source derived, and that recognition, realization, means the realization event has occurred, and recognition means that it's reported on the tax return for the year. Income that's excluded is deferred, not included. Excluded is never taxed, deferred is taxed later on when recognized in a subsequent year. So gross income, as we know, we've repeated this over and over, includes that deduction for cost of goods sold. And gross income is very broad, right? It includes all forms of income. So 451 says you're going to include gross income for the taxable year in which received by the taxpayer. So that is the actual receipt method, unless the method used is properly accounted for in a different period. Okay, so that doesn't really explain a lot. So the timing of income for a cash basis taxpayer we know is constructive receipt. We're not going to beat up constructive receipt again. We did that back in Chapter 5. Under the accrual method, however, the rules are different. So let's think about how do you recognize revenue under GAAP. And it's when the earnings process is complete, right? So typically we think about that as occurring when the good is delivered or the service is provided. Okay. So let's talk about what the test is under the accrual method for tax purposes. It says all events have occurred which fix the right to receive such income, and the amount can be determined with reasonable accuracy. So the accrual method has been defined in a Supreme Court case by the name of Schlude, and it defined what it meant for all the events to have occurred which fix the right to receive such income. And that occurs at the earliest of. So that's the earliest of the income is earned. Okay, well, this covers most transactions, and that's basically the way it works for book purposes, is when income is earned, you recognize it. The payment is due, or the payment is received. So the payment is received is a tough one to swallow, because that means if someone pays you in advance, whether you've completed the earnings process or not, under the all events test, you are required to record that income. So let's say you buy a Cheesecake Factory gift card for your friend for the holidays in 2017. And your friend ends up not going to the Cheesecake Factory until 2019, and then they pay with the gift card that you gave them. So let's think about what Cheesecake Factory's book accounting would look like. So in 2017, when they receive that cash, they're going to, of course, debit cash. And then they're going to credit deferred or unearned revenue, right? Because they don't recognize that revenue until they deliver the services. And in this case, they haven't. And so they just book unearned revenue. In 2018, absolutely nothing happens. Then in 2019, when your friend goes in, now they would convert the unearned revenue to revenue. And it also, I don't show the tax return or the journal entry here, but they would also reflect the cost of goods sold and the cost of services associated with delivering that food at that point. And that creates excellent matching. Under the all events test for tax, however, you would actually debit cash and credit revenue, because under the all events test, it's the earlier of. And the earlier of means they've fixed the right to receive this income in 2017. And then in 2019, they would actually book the cost of goods sold. So you can see that the all events test creates absolutely terrible matching. So the good news is there's now a new, there used to be elections for tax, but that's no longer true. They revised Section 451, thankfully, with the Tax Cuts and Jobs Act in late 2017, and said, look, you know what? Now we're going to allow you to defer what's known as an advanced payment. So that's when a taxpayer receives a payment in advance of having to deliver the services or goods to the customer. And we're going to allow you to defer that payment for up to 1 year, but never later than you recognize it in your financial statements. Now, of course, you can always recognize it earlier under the all events test if you want to. But what taxpayer ever wants to accelerate income? That goes against the general rule of the timing tax planning variable. All right, so let's do an example. November 1st, 2018, Arnold receives 4,800 advance payments for a 1-year contract to provide 48 dance lessons. So think of that as one per month, and he would recognize $100 of revenue per month each time he provides one of those dance lessons. So it's not one per month. So Arnold provides 8 lessons in 2018 and 40 lessons in 2019. So for book purposes, he's going to recognize 8 over 48, or 1/6 of the revenue on his books. If Arnold chooses to defer, how much would be included in 2018 and 2019? So Arnold elects the deferral under 461. So he can defer, but never later than the financial statements. So since his financial statements earned $800 in 2018, for tax purposes, he's also required to recognize $800 of revenue. Under tax, it's irrelevant what he did in 2019 because the entire remaining deferral must be recognized for tax purposes. So that's the remaining $4,000, right, of the 4,800 advance payment, $800 in 2018, $4,000 in 2019. All right, let's change the facts a little bit, except now it's 96 lessons over 3 years. So Arnold would recognize 1/12 in 2018 for book purposes, 6/12 in 2019, and 5/12 in 2020. And how would that get recognized for tax? Well, in 2018, it would be the exact same amount for book purposes, right? He can defer up to 1 year, but never less than book. So for tax, he takes in 1/12 of that revenue. In 2019, just as in the prior example, we no longer care what Arnold did for book purposes. He must recognize the entire remaining balance of unearned revenue in 2019 under the tax rules, because you only get up to 1 year of deferral. Therefore, in 2020, he would recognize nothing for tax purposes because, of course, he's already recognized all of that income. Okay, so a few exceptions, because you know how tax is. There are always a few exceptions. Prepaid interest and rent, those are always income. You get no advance payment deferral on either of those items. Now, rent has some really funny rules under Code Section 467. Those are beyond the scope of this course. I teach those in the graduate course, so we're just not going to go there. All right, now we can shift our attention to deductions. So the timing of deductions, the rules under 461 give us a very vague sort of statement that says deductions allowed shall be taken for the taxable year, which is the proper taxable year under the method of accounting for calculating taxable income. And so what they're really saying there is when you use the cash method for income, you use it for deductions. If you use the accrual method for income, you use that for deductions as well. So under the cash method, kind of a strict interpretation, the general rule would simply be you recognize deductions when cash is paid. So on December 31st, 2018, Wendy pays her business insurance premium for the entire calendar year 2019 for $12,000, right? So insurance is often a prepayment. They kind of require you to pay for insurance before the premium period begins. So what does the book accounting look like? Well, you would debit prepaid and credit cash, and then you would amortize that prepaid life insurance, that prepaid insurance over the life of the policy. So let's say, 1/12 every month kind of thing. So does the expenditure provide a future benefit? Yeah, well, yeah, it does, right? That's why for book purposes you tend to capitalize that. Well, the same is true for tax. Tax looks at it and says, well, look, we'll allow you to deduct a payment in the year in which you make the payment unless that expenditure provides a benefit beyond the end of the tax year, in which case then you're required to capitalize that cost just like you would for book purposes. But tax has a simplifying exception. That simplifying exception is called the 12-month rule. And the 12-month rule says if the contract benefit period is less than or equal to 12 months and that benefit period does not extend beyond the end of the following tax year, that you can go ahead and deduct the entire amount in the year you pay it. And the 12-month rule does not apply to interest. All right, so there's really no way to handle this except through an example. So on December 1st, 2018, Mighty Mart Corp, which is a cash basis taxpayer because they're small enough under the 26 million gross receipts rule, pays a $10,000 property insurance premium for a 12-month term that starts on December 15, 2018. Okay, so clearly, what is the benefit period? It runs from December 15, 2018 to, think of it, December 14, 2019. That's the 12-month period. Okay. So does it extend beyond the earlier of 12 months? Well, no, it's exactly 12 months. Does it extend beyond the first, well, that's the 12-month rule. No, it's exactly 12 months. Does it extend beyond the end of the taxable year following the taxable year in which the payment is made? Okay, so the taxable year following the taxable year in which the payment is made. The payment is made in 2018. Therefore, the taxable year following that is 2019. So does the benefit period go beyond the end of 2019? The answer is no. It ends in 2019. As a result, Mighty Mart can deduct the entire $10,000 on the date of payment. There is no need for them to capitalize and amortize that cost. Let's change it slightly and say that they make the payment on the same date for the same amount. It's also a 12-month policy, but they've prepaid it a couple months in advance. So they're paying it, but the benefit period starts on February 15th of 2019. So the 12-month then extends that into 2020. So does it go for more than 12 months? No, it's exactly 12 months. But does it go beyond the end of the taxable year following the taxable year in which the payment was made? In this case, the answer is yes, it does. So as a result, they must capitalize and amortize the entire amount. They don't get to say, well, part of it is done before the end of the year. It no longer matters. You either meet the 12-month rules requirements or you capitalize and amortize. Okay. Let's think about deductions for an accrual-based taxpayer, because that was just a bizarre twist on the cash basis taxpayer. So for accrual, they call it the exact same test, the all events test. But as you can imagine, the tax rules are built, and we learned this, right, with the whole advance payment, to accelerate the recognition of income, right? They don't want taxpayers to defer recognition of income. Well, for deductions, they do want them to defer as long as possible that deduction. So they take the all events test and they add an additional requirement to it called economic performance. Okay, so the all events test for deduction says a taxpayer deducts an expenditure when all events have occurred that establish the fact of the liability, right? So fix the right to receive or establish the fact of the liability, and it can be determined with reasonable accuracy, and economic performance has occurred. Okay. So economic performance is this new thing, right? So booking the liability, that's very much like you would expect under GAAP accounting. So if the liability is there, then you have, well, you have the liability. Of course you do. That's tautological, right? So if I've delivered the goods, for example, the liability's there. Okay, so economic performance comes in 4 categories. So what that means is the definition of economic performance differs depending on what the underlying transaction is. So when services and property are provided to a taxpayer, which is 95% of what happens, then economic performance occurs when the services or property are provided or when the property is used by the taxpayer. When services and property are provided by a taxpayer, economic performance occurs as such services are provided. And then the last rule is what they call payment liabilities. And in these, economic performance occurs only when the payment is made. Everything else, it says economic performance occurs as regulations permit or treat it like a payment liability. All right, so Captain Hook Corp is a calendar year-end corporation, purchased napkins and other incidental supplies in December of 2018. They are billed in January of 2019, and then they pay the bill in February 2019. So this is obviously an accrual-based corporation. When do they get to deduct the cost of purchasing napkins and other incidental supplies? So if the supplies were delivered in 2018 and they're a cash basis taxpayer, when do they deduct the cost? And when would they do so if they're accrual? And if the supplies were delivered in January 19 and they're a cash basis taxpayer, what about accrual basis? Oh, I see. I'm supposed to answer these as I work through. My bad. Okay. So if they're a cash basis taxpayer, they deduct them when they pay for them, period. Right? Let's see. If they are an accrual basis taxpayer, so what does that mean? As a cash basis taxpayer, they would deduct them when they pay the bill in February of 2019. Whereas if they're an accrual basis taxpayer, when economic performance occurs, well, when would that occur? It occurs when they receive those goods and services. So assuming that they acquire them in December of 2018, they of course deduct them in December of 2018. If they were delivered in 2019, then from a cash basis perspective, it doesn't matter, right? It's when they're paid for. As an accrual basis, now that would be shifted to 2019, the same year's payment. All right, if it leases the building in which it operates, in November 2018, it prepays 12 months rent for the period December 1st through November 19. When can it deduct rent? Under the cash basis, we've learned that normally you would be required to capitalize that cost and amortize prepaid rent. But under the 12-month rule, this lease meets the 12-month rule, and so they would deduct the entire amount in the year of prepayment, which is 2018. However, for accrual basis, you can apply the 12-month rule. That is permitted. However, you must also meet economic performance. Economic performance with respect to the use of property occurs as the property is used, which means that when you prepay rent as an accrual-based taxpayer, you cannot deduct it. You must amortize it over time. All right, services and property provided by a taxpayer. This is a weird one because we normally don't think about having a liability when we're the one providing the services. That's more of like the revenue generation side, right? I'm providing something to someone, they pay me. But this typically relates to a subcontractor system. So Colbert enters into a contract with the city to remove a wall for $1,000. Colbert decides that he doesn't have time to do the work, so he's going to pay a subcontractor $800 in December of 2018, right? So he's got to prepay the subcontractor, and then the subcontractor goes in and removes the wall in 2019. When can Colbert deduct the $800? Well, think of it this way. If they were allowed to deduct it when it was paid, right, then that wouldn't be right because none of the work has been done. So the rule says, no, they're not allowed to deduct it until the subcontractor provides the services in May of 2019. So payment liabilities, you cannot accrue until they're paid, which means you don't really accrue them. So what are payment liabilities? Liabilities arising out of workers' comp, tort, breach of contract, or violation of law. Liabilities for rebates and refunds, awards, prizes, and jackpots, insurance, warranty, and service contracts, and taxes. All of these are treated as payment liabilities, which means that You accrue them when you pay them. There are exceptions to the rules, because there always are. The first one is what we'll call the 3.5-month rule. So if a payment is made for goods and services to be provided to the taxpayer, and the taxpayer reasonably expects those goods and services to be provided within 3.5 months from payment, then the taxpayer can treat it as if economic performance occurred on the date of payment. So the idea here is this is supposed to eliminate book tax differences for really small recurring kind of items, right? But even though there's a recurring item exception we cover here in a second. So these minor accruals that take place at year end for like utilities and things, the tax rules say, look, let's make some exceptions and make this a little easier to conform tax to book. The second exception is called the recurring item exception. And it says that as long as you've met the all events test, economic performance will have been deemed to occur if actual economic performance does occur within 8.5 months, and the item is recurring in nature, and the item is not considered material. So note that the recurring item exception does not apply to interest. It does not apply to workers' comp and tort payments. So the recurring item exception really broadens that exception. It says, look, if economic performance does occur within 8.5 months, then go ahead and accrue that back into the year you make the payment. Okay, there are special rules for related parties, right? No surprise there. An accrual-based payer may not accrue costs to a cash basis related party until they are actually paid. So let's say GG Corp accrues a bonus to its sole shareholder, Gordon. That makes them related parties. But GG will not be permitted to deduct that bonus until it's actually paid because they are related parties. Okay, last item in this chapter has to do with accounting methods. So what is an accounting method for tax purposes? Well, if you're using a permissible method, that is any method you adopt and report in the first tax return you reported in. So that's anything you do for 1 year. Once you've done it, that's your accounting method. If you're using an impermissible method, which means you're doing it wrong, even if you do it wrong, if you do it wrong for 2 years, that's now an accounting method. So you have adopted it by using it. The reason that's important is changing an accounting method requires the permission of the IRS. Now, some changes the IRS waives and says these are automatic. So when they made changes to the tax law in 2017 in the Tax Cuts and Jobs Act, they created a large list of items that said, look, we recognize a whole bunch of taxpayers are going to have a change in accounting method because they weren't allowed to use the cash method. But now that the gross receipts test has been bumped up to 26 million, they can, and they're going to. So we'll make that an automatic change. You don't have to ask our permission. You just need to tell us you're doing it. Otherwise, you have to ask permission. It is always required to ask permission to change from the use of an impermissible method. So once you've used it for 2 years, you can't be like, oops, we discovered in year 3. Let's just fix it and don't tell anyone. No, you have to let them know and ask permission to do it first. Okay, so what happens when you make these changes? Well, sometimes you get a cumulative change in the amount of income or deduction you would have recognized otherwise. And so that's called a Section 481 adjustment. And if that's an income increasing adjustment, you're actually permitted to take it over 4 years. So let's say that you made a change in accounting method, and as a result, you had to accelerate the recognition of income. Let's say you went from cash to accrual method, and now suddenly you have accounts receivable. Well, what's the offset? If I debit accounts receivable, what do I credit? Revenue. So I put this on my books. Well, it allows me to take that revenue in over 4 years. So that's gracious of them. If, on the other hand, it's a income decreasing, they don't make me take it in over time. They let you take it in immediately. So again, the rules are here to promote good behavior on the part of taxpayers. So the IRS wants us to request our accounting changes, and so they're less draconian about that treatment when we do so. Okay, now just for a side note, If you are under audit and you make these changes, these same rules don't apply. They're way less generous. That brings us to the end of this video. I know it was a long one. Thanks for bearing with me.